Hey everybody, Marty Mazur. Good morning, 5th of September 2017. Quick video commentary for you. On the screen in front of you is a week ago yesterday's weekly analysis that we do here at Private Wealth Advisors. At the top, we have a summary of what we view to be key technical indicators for the S&P 500 in the first column, and for various sectors that we use, core sectors, if you will, and then defensive asset classes, at least two of them. This is something I've shown you a lot lately. As you know, there's a chart that goes with each one of these. Market was getting pretty volatile in August. Therefore, the shorter term technical indicators here, the 50-day moving average and the position in relation to that, was breaking down a bit in most sectors, which is shown here on the chart, where you see the price there jumping or dropping down below the 50, bumping up against the 100-day moving average. The overall longer term trend indicators, which we're most concerned with, those look very solid with the exception of energy. And of course bonds, and then gold looks somewhat suspect here. From an economic standpoint, things look good. Commodity prices doing very well, signaling global growth, if you will. And then some of the financial market indicators, I'm going to jump down here to breadth. Think of breadth as the extent to which all boats are rising with the tide, if you will. In an up market, you want to see good across the board breadth, which we have for much of the time. But again, we expect that to break down as volatility picks up. So I want to bring you forward to this week. This is yesterday's assessment, September 4th. As you can see, on a shorter term basis, things got better. The S&P 500 is no longer trading below its 50-day moving average, and so on. And we had a pretty good week last week. The macroeconomic data looks about the same in here. One area we did see improvement, of course, is in breadth. Because again, the short terms are looking better. So financials, tech, the advanced decline line looked up markedly. The number of issues within each index that are trading above its 50-day moving average looked better, and so forth. And even these ones that are red saw a pickup from the previous week. Now, as I talk here this morning, Dow's down 165 points. A couple of things there. We know that North Korea tested a bomb underground over the weekend, 6 such tests. Apparently this one was the biggest in terms of its impact. The size of the explosion was quite substantial. News this morning is they're readying to test another ballistic missile. I've shown you past periods where North Korea really rattles everyone's cages. I think we could say that it's not in anybody's best interest to go to war. But without North Korea, without that particular headline, as I've been illustrating of late, this is historically the season for volatility. Now, we tend not to trade seasons here at Private Wealth Advisors. We tend to be investors anyway, as opposed to traders. Nonetheless, we want to be very aware of what's going out there day to day, if for nothing else, so we can communicate to you what's happening below the headlines. And here is a chart courtesy of Bespoke Investment Group showing that typically the third quarter, right about where we are now, is when we begin to see a pickup in volatility. Traders, being very aware of that, will want to be on their toes and look for ways to profit from that. So North Korean rhetoric, and I don't mean to discount that, would have potentially an outsized impact on volatility, just given the sensitivity of traders. And here's a chart of my own that I posted yesterday. This is the spot VIX. This is where it was trading as of Friday at 10.13. And this is the 1 month, 2 month, 3 month, and 4 months futures contracts on the VIX. So as you can see, there's been what I would call a bullish divergence, or you might call it a bearish divergence, because this tends to go up when the stock market goes down. My point here is that futures traders are anticipating that volatility would be picking up, and they're making money today. So again, folks, my closing point here is that the macro backdrop looks good. Historically, when we've looked at periods that look like this on our macroeconomic charts, the volatility at the time, virtually without exception, had been volatility to ignore. And of course, that would be for patient, long-term investors who don't get rattled by near-term volatility. So expect it. It's the season, supposedly, but we do have enough going on here to maybe get some catch-up this year in terms of what would be a normal year of volatility. Thank you, as always, for watching and listening, and I'll talk to you again very soon. Take care.